Hello and welcome back to the Protea Academy YouTube channel. I'm Michelle, and in today's video we're going to be answering the question, what is gross margin and why it's important? As a business owner, you understand the importance of bookkeeping, and the information that a professional bookkeeper can provide you with will allow you to make informed decisions about your business. Now, one piece of information that your bookkeeper can provide you with is your company's current gross margin or gross profit margin. Your gross margin your gross profit margin is a good yardstick for measuring how efficiently your company makes money from the products and services that they provide, because it measures profit as a percentage of sales revenue. You can use your gross profit margin to compare your company's profits to others that have different sales revenues. And with all of that said, let's jump straight in. Gross margin is the profit that you've made after subtracting the direct costs of your products and services, and it's typically calculated as a percentage. Now, a positive gross margin indicates that you've been able to make your money back and then some, where on the other hand, a negative gross margin indicates that it has cost you more to make your products than what you've been able to sell them for. Now, essentially, the percentage is how much of a dollar you make as profit. So, for example, if your gross profit margin is 42%, you are making 42 cents for every dollar that you spend. In other words, you spend $1 to make your product, then you make $1.42 for the sale. This means that you've been paid back what it cost you and you've made 42 cents in profit. To calculate your gross margin, you first need to determine your gross profit. Now, to do that, we will add up all of our sales income, and secondly, we will add up all of the costs associated with manufacturing, procuring, and selling our product. Now that we've got our gross profit, we will divide that by our total revenue. So to put it in an example, let's say our company made $100 million in revenue, and after subtracting all of the expenses, we arrive at a gross profit of $32 million. Now divide the 32 million by the 100 million, and the result is 32%, which is our gross margin. One important fact to remember is that gross margin is not your total profit, and that's because there are some indirect costs that it doesn't take into account, such as taxes, licensing fees, and other expenses. So our net margin or net profit deducts all expenses and costs from our total revenue, and this will represent your true profit. Now, net margin, like gross margin, is very useful for business owners, and both percentages are useful when it comes to making decisions about your company. Gross margin can provide business owners with a number of key insights that can be applied in order to maximize profits and minimize loss. Now, first, it can tell you if your prices are too low or your costs are too high, or both. If you have a very, very small gross profit margin, then you may not be charging enough for your products in order to fully offset the costs. You may also be paying too much for the raw materials or for the manufacturing process. Some business owners make the mistake of assuming that just because their sales are good, they are profitable, and others may believe that their high gross profit margin indicates that they have good sales. Now, both of these statements can be true, but that is not always the case. You may have thousands of sales transactions going through in a quarter and yet still not be making a profit because your prices are too low or your costs are too high. And on the other hand, you could have a good gross profit margin and you may not be making as many sales as you could be. Now, knowing your gross margin will help highlight these issues, and you may discover that you are making a very small profit even though it seems that your sales are good. When calculating your gross margin, you'll also be calculating your overall product costs. Now, by looking at these numbers, you'll be able to determine if you are selling your products for too much or if you're selling your products for too little. So high sales but low profit margins could indicate that you are undervaluing your product. On the other hand, low sales but a high margin could indicate that your prices are set too high. Now, a good bookkeeper will remind you that you cannot look at gross profit margins in a vacuum. There are many factors that affect pricing, and all of these factors need to be taken into consideration. The market sets the price, so if the market dictates lower prices, you'll need to adjust your costs in order to meet them. addition to price, you can also use your gross margin to see what you're spending on your products and services. New business owners may be surprised at how much they spend. If your gross margin is low, but you feel that your pricing is fair, then there are two factors to consider. The one factor is marketing, which is a separate area of discussion, but the factor that you want to spend or focus your attention on is your overall costs. So if you feel you're spending too much, then you may want to consider alternative materials, new partners, or renegotiating current contracts to lower these costs and to grow your business. All business owners should consider their gross margins on a regular basis, whether that's monthly, quarterly, or annually. Small business owners can use gross margin to help them determine if they are charging or pricing their products correctly, or if they could potentially save on costs. Marketing experts can look at gross margins and see if their marketing plans are meeting their goals. Even experienced business owners and bookkeepers can use gross margin to compare previous fiscal years and project their company's growth over the next few periods. If you have a bookkeeper, then they can calculate your gross margin and help you understand what it means in terms of sales, expenses, and profits. However, if you don't have a bookkeeper, you do run the risk of miscalculating your margin or not fully understanding how to use it in order to make financial decisions. As always, we trust you found this video insightful, and should you have any thoughts, comments, or suggestions for future content that you'd like to see, please feel free to drop it in the comments section below. Please also join us on our social media platforms such as LinkedIn and Facebook, or at our website at proteafinancial.com. Protea Academy, striving to achieve better accounting for everyone.